Money cannot buy you happiness. Poverty can't buy you anything. That's really the path for most traders, is unsuccessful production of capital, meaning we're actually losing money. If you think about creating wealth in terms of a broader plan, there are a handful of really important concepts that I'm going to share with you, 3 of them to be specific. And these are the exact things that I've used coming from a single mom in a low income area to being a multi-millionaire before I'm 32. And that's not some sort of big flex. I am a Neanderthal, just like most other traders. The point I'm trying to highlight here is that it is entirely possible to find your way into a different trajectory if you are thoughtful about what you do. What's up, everybody? Eric here. Welcome back to All the Outliers. Shout out to the YouTube members and the Patreon fam. Thank you guys for supporting the channel, and let's get right into it. The very first thing that you are going to see here are some things that you're not going to want to hear, and it's whatever. It is what it is. The very first thing, the $5,000 account, the $10,000 account that you start with is not going to be your future wealth. So this idea of starting with a small amount of money and trading it into a huge amount of money just sets you up for failure to the highest probability. Do not do this. This money is your starting capital. This is not what's going to be your retirement. Early on, obviously, the inverse here is saving. Saving is the hands down most important lever you're going to pull on early. No, that's not sexy. No, that's not fun to hear. It's the reality, because most of us are not special. What I mean by that is, yes, we might think we can pick up the skill set of trading. We might think that we have a high propensity to be super successful at it. We have the skills that might lend us to that success. However, this is the reality. Most people do not. Most people are posting on Wall Street bets that, please help, I've not slept in days, because their position is down 47% over the course of a few days. This is the reality. So what I offer to you is, while you might be special, you might have the proclivity to be fantastic at trading, you don't really know it up front, and most of us aren't. So I would avoid planning on the fact that you are Rain Man for your future wealth. What I mean by that is focusing on a more probabilistic outcome. That's what I did. So what does that actually mean? Well, we need to take a look at a few things. The first one is the compound growth calculator. I've done a bunch of videos on these, but what I want to highlight here is this is starting with $20,000 at a 12% yield annual for 20 years. Notice the $100 a month contribution gets you to $280K. The $1,000 a month gets you to $1 million. What does this tell you? Saving. Saving is incredibly important. Now, the ability to change this interest rate by getting better at trading is important, but saving is accessible to all of us. The variable that is this, in terms of the interest rate you're able to produce as a trader, it's a bigger variable. And again, statistically speaking, most people are not going to outperform the market. It's a pill that's hard to swallow, but it's an important one to acknowledge. The other thing is conservative estimates. When I'm filling in these things like the monthly contribution to figure out where I want to be in X number of years, I'm not pretending I'm going to be able to put everything in there. I'm going to plan conservatively. That includes both the yield and the monthly contribution. But what I'm highlighting here is trying to create a realistic target for you. The only way all of this can happen is if we embrace this, delayed gratification. And you might be saying to yourself, Eric, it doesn't seem like you're delaying gratification. And you're right. At this point, I've delayed gratification long enough to be able to afford things that I enjoy, from automotives to trips to Kauai, to dive trips to Curacao, to a $2 million house in Southern California. All of that comes down to careful planning, and it starts with delayed gratification. The better job you can do with this early on, the bigger the impacts you're going to see on these numbers. Because again, even if you're a really great trader, you can drive the yield of your returns up. The more you can turn this number up, the better the results are going to be more quickly. The other thing I want to highlight on this page is paper trading. This is is another thing that everybody hates, but going back to the idea that we are not special, the whole idea of trading is we think we can outperform the market. You think you could do better than the market. We know statistically that that is a small subset of traders that can do that. But what does that mean? We think we can do something that a lot of people try and they fail at. That means you're special. But I'm just saying we're not special. So how does this happen? You got to develop the skill set. It's just like if you do any sort of martial arts, there are times when somebody with very little experience can walk in like John Jones. He can train for a relatively short period of time and he could just start crushing people. That exists. Guess what? Life isn't fair. Most of us don't fall into that category and we have to work our asses off to find that same level of success. That's what this is. The whole idea of paper trading is to make sure that we are developing this skill set while avoiding some of these big pitfalls. And that's what I want to talk to you about now, is the pitfalls. The first one I want to cover is this right here, the skill gap and drawdowns. If you start trading right out of the gate because you think you are Rain Man and you're super good at this, and despite what everybody says, you're not going to be that guy, and you're not in the scenario where, you know, you're losing all your money like this dude and you're going to be great. Cool. The problem is good traders make it look easy. That's the skill gap. So it can be very misleading. That's one of the issues with trading in general. The stock market is unbelievably misleading in that way, where the people that do a good job, they make it seem easy. We want to do things like automate everything. We want algos to do it for us. There's a reason why those don't dominate the marketplace yet, because as soon as we can do that, everybody will do it. Even though there are small subsets of people that can make a lot of money trading, realistically. So we got to make sure that we are guarding against skill gap and making sure that our growth rate makes sense for our skill set. The head in the sand approach is super common. It's when traders, they don't want to have a trading plan. They don't want to be held accountable for what they're doing. They don't want to be responsible for the outcomes. They want to be able to blame things, so they don't have a trading log. And essentially we just go in circles because our ego prevents us from making good decisions and making sure that we're controlling things. The problem with this is you're not going to gain any traction. If you do not have a paper trading, or if you do not have a trading plan, and if you do not have a trading log that is documenting your capacity and your success in paper trading, you are putting your head in the sand. You're just hoping that you're going to figure it out on the fly because you do better under pressure, or you perform better when you have skin in the game. I'll tell you what, I'm really thankful we don't say that in the Marine Corps, that in order to prep for war, you don't have to get shot to practice getting shot at and moving under pressure. It's a really awful approach to high volatility scenarios, and it includes trading. So what you need to avoid is drawdowns. What do I mean by that? Well, there's a big problem with drawdowns. Take a look at this account. I have a video that's going to come up soon, but take a look at the returns on this account. Just portfolio 3 over here. They have a 30% return, a negative 25% return, then a 12%, 14%, 12% returns. By all accounts, that's a pretty damn solid series of returns, and it's an average return of 8.6%. Look at the compound annual growth rate. Look at the ending value. They have an 8.6 average return, a 6.87% CAGR, but 140K. Let's take a look at portfolio 1. 10%, 10%, 10%, 2%, 10%, 5% returns. Not one of these cracks even the lowest positive return over here. However, the average return is 7.4%. It's less than the average return over here. Look at the compound annual growth rate, 7.35% compared to 6.87%. That means that on these smaller returns, you have made more money than this person with a 1.2% better average return. This is the impact of drawdowns. The last thing I want to note here is the myopic approach. This is a video, or this is from a video I put out last year on a rental property that I sold. I made $263,000, and it was tax-free because of capital gains tax on recently lived in properties. There's different tax codes that apply to real estate. But the point being is I made decent money trading. However, we can also make money in other endeavors, and I cannot overemphasize how important it is to do that. I do not just trade. I am an angel investor. I am also involved in residential and commercial real estate. Beyond my investing stuff, beyond the stuff I'm starting to do with YouTube, you gotta find other ways to increase your income, because because if you increase your income, when we look at the monthly contribution, what you can save to then compound with the skill set you've developed, that's where it comes from, making more income. So all in all, trading can be incredibly lucrative. I've done very well trading. I've outperformed the market for the last 15 years running. You can do well. Even still, it is so important to have a holistic approach to your wealth development. And for traders, that includes the concepts I outlined here. So if you made it to the end, don't forget to like the video, throw down in the comments anything that stood out to you or anything that I missed from this list. And until next time, be an outlier. See you later. Don't forget to subscribe.